It's time for Yahoo Finance's Market Minute. Stocks wavering, that three-day rally losing steam, consumer sentiment falling to one of its lowest readings on record, and long-term inflation expectations rising. Alphabet reporting a strong first quarter, announcing a 5% dividend increase and $70 billion in share buybacks. Growth was driven by Alphabet's ad and search businesses, as cloud revenue came in just shy of estimates. Meantime, Meta laying off over 100 employees in its Reality Labs division. Last quarter, Meta's Reality Labs division reported a nearly $5 billion operating loss. Its next report is on Wednesday. And Intel issuing weak revenue and profit forecasts, the street seeking more from the new CEO's turnaround strategy. The company reported strong results in its first quarter, analysts attributing higher sales to customers buying ahead of tariffs. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, stocks are set for another day of gains after weeks of turmoil. I'll speak to a strategist about what investors should look out for in the weeks ahead. And how can home buyers win this spring? I get one realtor's top tips for weekend home shoppers. Plus, all week on Wealth, we're bringing you a guide to financial products. Everything that you need to know about opening different accounts, CDs, and debit and credit cards. Today we focus on credit cards, a beginner's guide to applying for your first traditional credit card and your first travel card. You don't want to miss that. First, let's begin things as we always do with a check on the markets. We're 90 minutes into the trading day, and right now, we're mixed. After a three-day winning streak, as ongoing trade tensions weigh on investors, they're top at investors' minds right now. Joining me now, we've got Adam Coons, Winthrop Capital Chief Investment Officer. Adam, you say that investors are trading too much on emotion, perhaps listening to a lot of Mariah Carey at the top of the playlist. What should investors be focusing on instead, in your view?
Well, I think first and foremost, if you are having visceral emotional reactions to, stocks being down in particular, and just kind of what markets are doing, it's probably time to reassess your, kind of risk appetite. And, did you get caught up in the FOMO trade over the last couple of years and may have come into this year just a little bit, like I said, with too much risk in the portfolio? Because I can say from our perspective, we did come into this year a little bit more defensive than usual. And so when, we're in that opportunity, we see this as a period where, we can kind of look around and find spots that we didn't think we were going to get a second chance at. And so that's what this should be. The world doesn't come to an end very often. And so I think at the end of the day, fundamentally, there hasn't been enough that's changed. There are some things that could change, but I think right now we need to use the information we have, the earnings that are coming out for some of these companies, like you just led on with Alphabet, do look good. And so I think there's some fear about the future, the fear about a potential recession. But until something fundamentally changes, those things should not be an investor's base case.
And so with that in mind, as you're thinking and hearing through some of the CEO commentary and executive commentary over the course of this earnings season, how is that governing and the long-term outlook governing where it seems like a right opportunity to pick and choose those areas to perhaps set some longer-term positions?
Yeah, I mean, look, there are some obvious spots where depending on where tariffs go, in particular, with China and the exposure there, some companies are more exposed than others, sure. But I think you also need to look at, the mobility of those companies. You've already seen that Apple's come out and said they're going to shift production of iPhones that are, coming here to the U.S. to other places, in particular India. So, look, I think that a lot of this, regardless of how it ends up from a tariff standpoint, still is going to be short term, because you better believe these companies, with the amount of market cap and cash that they have, are going to find a way to mitigate this. And so so we might have, like I said, more volatility this year, a little bit more uncertainty, but like you just hit on, as an investor, you should be looking long term. And so those high quality companies, your NVIDIAs, your Apples, Microsoft, the business models haven't changed. The things that were working will not change because of this. Will there need to be maybe a deviation of how they get to the consumer? Potentially. But overall, those high quality companies are still high quality companies. And I think that's where you need to look. It's the companies that really came into this that were, poor quality earning companies that may not get through this very well. And there may be an increase in defaults in those kind of companies. But once again, I think investors should be really focused on those high quality companies.
Where are we at in the kind of map of the broader kind of thesis right now, especially as there was more of the thought process around buying the dip that was early on in the slippage, but then we started to hear of sell the rally. So where are we at in those kind of competing mentalities among investors from what you're seeing right now?
I mean, it's somewhat of a guess, but my guess is we're, midway through. We're probably kind of approaching halftime of the game. And that's really based on, there is still a lot of uncertainty. There's going to be more uncertainty, later in the year as we start to talk about, what happens to the Federal Reserve, their policy changes. And then obviously, what happens with Powell and the replacement of Powell. So those are things that we'll probably need to deal with through the midsummer. And so there's still a lot of things, like I said, the more things that create uncertainty, that keeps me in this mindset. We're probably going to be bouncing around here range bound for a little bit, like I said, with that higher volatility. So probably halfway through it, and then when we start to see, it feels a lot like 2022 when we came into the year, everyone was saying we were definitely going to get a recession. We never did. So it kind of feels the same way, where everyone's guessing about the probability of a recession. I think as we start to kind of see what the U.S. employment number continues to look like, what inflation looks like, and then ultimately what the economic growth looks like, then we'll kind of come out of this on the back half of the year, essentially kind of unscathed.
Adam, just lastly, while we have you, I know that you've been looking at the cybersecurity landscape, and this was an area that was seen as some potential kind of vulnerabilities to if there were massive cuts on the spending side, both from businesses and as a result of some of the actions that DOGE was putting into effect as well. How are you looking at the space and evaluating some of those cybersecurity names right now?
Yeah, I mean, it's a valid fear, once again, short term. But I think many of us have probably gone down that path where the things that you cut end up hurting you the most. And I think cybersecurity is one of those that if you did start to see cuts, you would immediately regret that decision. And so for us, we see this as definitely a buy the dip, just overall sector. We like specific names like Fortinet within the space. But ultimately, the need for increased, more complex cybersecurity is only going to increase as the AI story has lost its luster for the moment because of all the other things going on, all the other distractions. But once again, you better believe if we start to head back into a rally mode, that will pick back up. And anytime that we move down this aggressive path of artificial intelligence, you're going to have to balance that with cybersecurity. So there's just no way this is going away. So for us, this is a top conviction buy from a sector and a stock standpoint.
Adam, thanks for taking the time here with us today.
Yeah, thank you.
Now time for some of today's trending tickers. We're taking a look at 3 earnings movers. We've got Centene, we've got Skechers, it's the S, and Carter's joining me now. We've got Market Domination co-host Julie Hyman here on set. Good to see you, Julie. First up here, we got to talk about the healthcare provider, Centene, raising its sales forecast for the year with strong enrollment in its Obamacare exchange plans. However, shares sliding after the company noted higher costs associated with its Medicaid plans. Shares lower by about 7.25% right now.
I got an acronym I'm going to throw at you.
Yeah,
I know
ready.
You love the acronym.
I love acronyms. Big acronym fan.
MLR, medical loss ratio. This is an important number when we're talking about health insurance companies. It is the percentage of premiums that they pay out to cover healthcare. It's another way, basically, of looking at their margins, right? How profitable are these companies? Well, in the case of Centene, its medical loss ratio last quarter was 87.5%. That was in line with estimates. For the full year, the company says that that ratio is going to be 88.9% to 89.5%. It looks like that is an increase. In other words, it is negative. It is paying out more of the premiums it collects to cover the cost of care that it is insuring here. And so that's something that a lot of analysts have pointed to. Also, the company raised its full year revenue forecast, but didn't raise its profit forecast, sort of on a similar note. So just some profitability focus here for investors. At the same time, because this is an insurer that is heavily indexed to Medicaid, and as we know, maybe there are some concerns about Medicaid cuts. That's something, not necessarily through this earnings, but that's something that investors are thinking about.
All right, they're factoring into some of the share price action we're seeing today. Next up, let's go where the feets go. Well, shares of Skechers sliding after the company withdrew its outlook for the full year, citing macroeconomic uncertainty tied to the global trade war. Now, previously, Skechers was expecting annual sales of $9.7 to $9.8 billion in a filing. Skechers said in 2024, substantially all of its products were manufactured outside of the U.S., primarily in China and Vietnam. Shares right now are down by about 3.8%. It's not taking a hit as much as it could be, perhaps, on the share price action here on the day, considering what they did disclose in the outsized majority of their manufacturing.
Yeah, you know, it's interesting here because the company emphasizing in its conference call that, yes, first of all, it won't, that information about where its stuff is manufactured didn't come from the company today. It said they said they don't like to give you precisely where their production is coming from, but they did say that all of this is going to have an effect. The other thing that they kept emphasizing on the call is how much of their sales are outside of the United States. They say 2/3 of the business is outside of the United States and therefore would not necessarily be subject to the same kind of tariff. So that's something to keep in mind. Looking at some of the analyst commentary here, it looks like that analysts are looking sort of, you know, they're looking further out here and trying to figure out whether some of this has already been priced into the stock. So depending on who, some of them are saying that's potentially the case.
Yeah, you got some positivity in their wholesales growth. That was up by about 8%. Direct to consumer, that also grew by about 6% here. But gross margin, that seems to be where there is a little bit of pressure that investors are dialed into right now. That was still 52%, but a decrease because of some of the lower average selling prices.
Right, and then the question is, if they get hit with tariffs, will that be further crimped?
Exactly.
Yeah.
So let's also round this out with children's clothing brand Carter's. Let's dive into that one. That's also suspending future-looking guidance as the company recently appointed a new CEO, saying tariffs introduced substantial uncertainty here. Shares of Carter's right now, they're down by about 8.25%.
Yeah, this is a children's clothing staple, right? Carter's brand, that is. The company's new CEO just started on like April 3rd, so that's one of the reasons they're talking about. But obviously, tariffs are also an issue here. And Carter's was more specific on its call about where it makes its stuff. So they said they have reduced their reliance on China because of what's been going on over the past couple of years. And they said now they make a lot of their stuff in Vietnam, Cambodia, Bangladesh, and India. Those represent the largest countries of origin. And then at 2024, China production was less than 2% of their apparel and accessories country of origin. So that's something to keep in mind. That said, they also said in the call the proposed higher tariffs would result in meaningful increases to our product costs, if not otherwise mitigated. Now, Carter's, like Skechers, like all of these companies, they don't want to raise prices.
No.
That's what they're saying. They don't want to have to raise prices because in this environment, especially, they're concerned about a hit to demand if they do raise prices. Right. So a lot of them are trying to move things around. Where can we make things differently? Where can we ramp up production, ramp down production? And so different ones sort of have different flexibility in order to do that.
Same with the clothing attire too.
Yeah,
Carter's
exactly.
of Oshkosh fame. Julie, thanks so much.
Yeah.
Appreciate it. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, insights from women investors on why they got into the market, plus the one thing that they may regret. That's next on Wealth. According to a study from Schwab, nearly all women investors say handling investments makes them feel empowered and that they're confident in their financial decisions. And 85% say that they wish they started investing earlier. Here with more insights and advice for women at all stages of their investing journey, we've got Jeannie Binder, who is the Schwab Branch Network Head. Great to have you here with us, Jeannie. So what are some of the reasons that you're hearing from women about why and how they get started in investing?
Yeah, thank you, Brad. Thanks for having me. We are seeing some incredible results from our recent Women Investor Survey. Women cite that some of their top strengths are patience and discipline, which is really no surprise given most are, really focused on reaching long-term financial goals. We also know that there have been many lessons learned along the way. 58% say that staying invested through market volatility has been an important lesson for them. 57% cite acknowledging their risk tolerance, and another 54% say diversifying their investments are really important for them.
So what are some of the challenges that you're hearing women face when it comes to investing?
To start, I would say that it's worth noting while there are many challenges, most feel like they're on the right track to meeting their financial goals, about 90%, which is incredibly encouraging. That being said, the survey found that there are still 3 hurdles for women to investing. First, limited earnings. About 65% cited limited earnings could be due to lower pay or wage gaps, potentially career breaks or caring for children. 2, lack of early financial education. And then the third one, limited funds to start. So just a feeling like there's no excess money to get invested. Women also live longer than men too, so need to plan for longer time horizons.
So as we think about the last few years, it's become extremely evident how much more people are comfortable talking about their investments. I mean, some posting about it daily on social media and talking about it with their friends. What is the role of community that you're seeing?
Community is essential. Women show that 2/3 discuss financial topics with others, most likely family and friends. And often they're doing so to learn, to support others in decision making, and also to validate their own decisions. This exchange of knowledge, obviously builds confidence and also just helps to normalize some investing conversations.
So what are some tips that you have for potential women investors, those who are saying, you know what, I'm just trying to figure out the right entry point and how much I should start to put into the market?
Yeah. First, I would focus on education. Now more than ever, as you mentioned, there are so many resources that offer clear and simple financial information out there. If you're in a relationship, I would say both members of the couple should have a complete knowledge of your both individual and shared finances. So whether or not each of you is actively involved in financial decision making, you should both know the big picture, things like net worth, cash flow, debt, insurance, investment accounts, retirement savings, and estate planning. Third, I would say know your worth. Do some wage comparisons for your job. Don't be afraid to negotiate for compensation. Have a sense of the work you do and those transferable skills and where you can apply to multiple jobs. Fourth, I would say create a strong financial foundation. Get the basics squared away, create a budget, get an emergency fund with at least 3 to 6 months of essential expenses, making sure that you have adequate insurance also to prepare for the unexpected. Build your credit history, stay on top of your debt. I know it's easier said than done, but try not to charge more than you can pay off each month. Have a plan to pay off if you do have revolving debt, that high interest debt that you may be carrying. Start saving or increase your savings ASAP. You can, write down your goals, short, medium, long term. You can have a plan for each of those goals, and the more specific you are to your time horizons, the better. And make sure you're saving for retirement. That should be at the top of your list. And then last, I would say invest early. You mentioned at the beginning, 85% of women investors cite that they wish they would have started sooner. So you don't have to have a lot of money to start investing. Don't be afraid to start small. Consider $100, $500, and just go from there, build from there. When you're young, you have time. Remember, you have time to ride the market ups and downs, and don't let volatility scare you away.
Jeannie, just lastly, while we have you, we know that women are set to be the largest beneficiaries of the great wealth transfer. How are we seeing in some of the kind of early sentiment and strategy around how women are investing right now, where that could benefit certain industries, certain investment ideas, and even the community that is then bolstered even further from there?
Yeah, I mean, the great wealth transfer that's coming before us, we know it's going to change a lot of the demographics of who's sort of in control of a large amount of the wealth and investing. No surprise to me when we surveyed our female investors, when they first started investing, they're doing so to grow their money, to save for retirement. They're very focused on having patience and risk tolerance over time. And notably, about a quarter say that they start investing simply just to learn how to invest. And so, we're sort of seeing that play out across and amplify year over year. And so it's exciting to see, and again, just very encouraging with the trends that we're witnessing right now.
Absolutely. Thanks so much for breaking down some of the trends that you're seeing and bringing the conversation our way. Appreciate it, Jeannie.
Thank you for having me.
Coming up, weekend home shopping. A Denver realtor joins the program to provide the latest insights into the housing market and tips for your home shopping journey. Stay tuned. We are 2 hours into today's trading session and taking a look at the activity that is transpiring in front of our eyes. We are across the sectors right now seeing more laggards than gainers. However, holding up things, we've got consumer discretionary. That's up by about 0.9% right now. However, as we've got more sectors in negative territory, let's focus in on materials for a hot second. That's down by about 1%. Also, consumer staples, you're seeing that lower by about 0.7%. Some fractional declines elsewhere in financials, as well as utilities and energy. Let's take a look at the NASDAQ 100 here, checking in on some of those names as Google, Alphabet, whatever you're calling them. Call them a company that just reported earnings after the close yesterday, and ultimately shares right now up by about 2%. It's off of its session highs. As you can see, we were just a little bit higher at the start of today's trading session, and ultimately still in the green right now. Meta, that's also catching a little bit of a bid here on the day. Perhaps a lot of the thesis permeating from Alphabet into Meta as well about what both companies could be seeing within the digital advertising landscape. And then additionally here, checking in on NVIDIA. This one's been an interesting one. Started off the day in negative territory. Now you're seeing it up by about 2% here. Also, want to check in on the major averages just to, and I should have began there. I typically do. I wanted to change things up for you because it's Friday. Why not? The NASDAQ composite, you have that higher by about 0.5%. The Dow Jones Industrial Average, you're seeing that down by about 0.5% right now. And the S&P 500 trying to make up its mind. It's been teetering over the course of today's activity, hyper oscillating, waffling, whatever you want to call it. It is right now higher by about 0.1%. We'll see if we can hold on to some of these gains, and in the case of the Dow, get into positive territory on today's activity to really solidify the consecutive days of gains that we have seen over the course of this week. The average mortgage rate ticked down slightly this week, according to data from Freddie Mac. Rates have held relatively steady over the past few months, fluctuating by no more than 20 basis points. So, how has that translated into housing market activity? We're checking in on the spring home buying season with Kathy Casey, a realtor at Coldwell Banker operating in Denver, Colorado. You're giving us all the Nuggets vibes right now, Kathy. So what's the current state of the market out west?
So, we are in full swing of our spring market right now. We're seeing a flurry of activity. But we've also seen the whole gamut this year with consumer confidence being up and down. So we've had open houses where we couldn't even shut the open houses down. But we've also seen some homes that are sitting on the market with not a whole lot of activity. So we really kind of see the potpourri of things these days.
Open houses that you can't shut down. That sounds like a house party right there. You always tell your clients, marry the house, date the rate. Explain that for us.
So basically, I think that a lot of consumers are so focused on what the interest rate is now. And instead of focusing on what the interest rate is now, I always like to say to my buyers, you actually make your money when you buy. So there's always opportunity in this type of market. So in this type of market versus the market when 2020 or 21, when interest rates are really low, maybe you didn't get a chance to actually bid on the house that you really want, or you got outbid. There were a lot of people that got outbid. They had to make a decision in 20 minutes, whereas now with the market being the way it is, you actually can take your time and thoroughly look for the house of your dreams and really weigh all the pros and cons of everything and really, sleep on it, before you decide to make a decision. So, but marry the house. So, find the house that you want. Don't worry about the rate. They will, they're going to fluctuate right now. They're fluctuating somewhere between 6.5 to 7.5 pretty steadily. And I don't think they'll ever go down, or at least it's going to be a while before they go down to where they were a few years ago. But if they do go down, you'll already be in the house that you want. You won't have paid over price. You won't have competed, and you'll be in the house of your dreams.
So what advice would you give someone who's planning to hit some open houses this weekend, bop around, maybe, kind of put some notes down on their list of what's striking a chord and perhaps what they should just continue to move on from and move out of their mind?
Yeah, so, I've got some tips for, if you're going to be going out this weekend. One thing you want to do is make sure you know your numbers. So as you're looking at a house, and you might think, oh my God, this is my dream house. But when you find out how much the actual payment is, maybe it's not your dream house, okay? So know your numbers. And although, let's say, for example, that you're approved for $500,000, well, that might look very different in different communities. So if you're in an HOA community, or if you're in a community where the taxes are a little higher, that $500,000 that you're qualified for might actually only give you purchasing power of $450,000, and vice versa. You could be the opposite. If you're in a community without an HOA or lower taxes, you might have more purchasing power. So know your numbers. Ask your agents to run the numbers for you for the house you're going to see, just so you have an idea before you go.
And so there are a lot of thought processes that potential buyers have to go through, whether they're looking at an existing home, but they could also be touring a brand new, never been lived in, potential build or current build. So what should would-be buyers keep in mind in some of the kind of new home side of the equation?
So in the new homes, if you're looking in the new home market, some of the builders are running really great deals right now, particularly on interest rates. Some of them are buying interest rates down for the full 30 years. But you want to make sure you bring your agent with you on your first visit. If not, they won't be allowed to represent you. And also, you want to take your agent with you when you go to the design center as well. You want to make sure if you're customizing a new build that you are not over improving, okay? Your agent can help you decipher which upgrades are going to help you in the long run and help boost your resale value.
And so touring a house can be exciting. It can be overwhelming and quite honestly emotional here. So what are 4 things that people can overlook at an open house that you think are definitely worth considering?
Okay. Well, things worth considering. So let's say if you're in the condo market, I want to first point out that there's a lot of turmoil going in the condo market right now. Fannie and Freddie have recently updated their requirements, and due to rising insurance costs, a lot of HOAs have increased their deductible, and they are no longer meeting the Fannie and Freddie guidelines. Okay? And the worst thing about it is a lot of these condos are not aware of this is happening. Their maximum deductible needs to be about 5%, right? And also, if you're in an HOA area, you want to make sure you inspect the common areas. Are there maintenance? Are there dirty hallways? What's the neighborhood like? How's the commute at rush hour? It can be emotional, but make sure is there enough storage, in the house for you? And what does the neighborhood look like at night? So all these things for you to consider.
All right, very key to consider. And if you're in New York, make sure that you see what the area, especially at night, what some of that noise might sound like. That is something that's gotten me in trouble in the past. Kathy, thanks so much.
Thank you very much. Have a great day.
You too.
Thanks for having me.
We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. We're looking at some of the ways that you can spring clean your finances and set yourself up with a good financial habit and runway for the rest of the year. Today, we're focusing in on organizing your investments. And here with more, we've got Christine Benz, Director of Personal Finance and Retirement Planning at Morningstar. Christine, great to have you here with us. Let's start nice and easy with a lot of people's worker-sponsored retirement plans, AKA the 401k. So what can you be doing there to make sure you're set up for the year ahead?
Well, we're still early in the year, so it's a good opportunity to see how much you're saving. We have seen the contribution limits lift a little bit over the years with inflation. So if you're under age 50, you can get $23,500 in there. That's the max. If you are over 50, it's $31,000. And then there's this catch-up, this super catch-up contribution that's available for people who are getting quite close to retirement. So between 60 and 63, you can get almost $35,000 into a 401k. So see how you're doing in terms of those contributions, because it's just such a nice, low maintenance way to get money into your account on an ongoing basis.
So moving beyond your 401k, how can you clean up your broader portfolio and make sure the investments are working for you?
Well, a really good thing to look at today would be your portfolio's mix of stocks, bonds, and cash. Use a tool. We've got a good one on Morningstar.com, but there are lots of tools available where you can check up on how your portfolio is apportioned and then compare that to your target for your asset allocation. And at this point, a lot of people might say, I do not have a target, in which case you can either get some financial advice or you can use kind of a quick and dirty route, which would be to look at a target date fund that is geared towards someone at your anticipated retirement date. See how they are allocating their assets. Today, I think a lot of older adults, like people over 50, are pretty underweight relative to the reasonable targets for safer assets. It just has not been a great place to invest over the past several years to have investments in fixed income. But I think that safety is really important for people at that life stage to at least have something in safe assets. And then people who are younger, really check that non-U.S. relative to U.S. allocation. U.S. equities have been the path of least resistance over the past couple of years. So many investors are pretty underweight non-U.S. And of course, that's where the action has been so far this year.
And so the major key of this conversation also may come in two words, and that is risk check. How can people who are viewing make sure that they are performing a risk check to make sure that they're on track with their investments and balancing that risk reward?
Yeah, so checking up on that asset allocation is a key part of this. Also check your portfolio style and sector exposure. You were just talking about the tech names, Brad. Well, even though they have had bouts of underperformance so far this year, many investors are quite overweight in those U.S. large cap tech stocks. Maybe they will continue to perform well, but most investors are pretty heavily tilted there. So check up on your style and sector exposure and see if you can't tip more into some things that haven't performed as well that may do so in the future. Also check those company overweights. So many people receive incentives via employer stock. That's a really risky area to be in because so much of people's financial wherewithal is riding on their employment.
There's a couple weeks left until taxes are due, but how can you make sure that you're utilizing tax-efficient investment strategies for the year ahead?
So first, make sure that you are maxing out those tax-sheltered account types, whether company retirement plans, IRAs are a good contribution opportunity. If you didn't contribute to 2024, you can sneak in a contribution before that tax filing deadline. If you are someone who has the wherewithal to have investments outside of retirement accounts, you just want to make sure that those are positioned as tax efficiently as possible. So they're broad market index funds make sense. Exchange traded funds that track the equity market are good options. For higher income people who need to have safer investments in those taxable accounts, you'd want to look at municipal bonds. So those would be some kind of best practices. And then in retirement, there's a lot you can do in terms of managing the tax burden of the money that you're pulling out of your retirement accounts.
Christine, thanks so much for taking the time with us.
Thank you so much, Brad.
Coming up, your guide to financial products. Today, we break down everything you need to know about credit cards. That's next on Wealth. Hotels have them, airlines have them, and credit card issuers offer general ones. Finding the best travel credit card can be a challenge. Yahoo Finance senior credit card reporter Ben Walker breaks down how to choose the right one for you.
If you want to take your next trip on points and miles, Choosing the right rewards credit card could be the key to a less expensive or more luxurious trip. I write about credit cards for Yahoo Finance, and I can help you find the best travel credit card, the best airline credit card, or the best hotel credit card for you. Here's what to consider. There are two different types of travel credit cards. You have your general travel credit cards. Credit card issuers for general travel credit cards are Chase, American Express, Capital One, Wells Fargo, Bank of America, Citibank. You also have airline credit cards and hotel credit cards. All major airlines have an airline credit card. For example, you have United credit cards. You also have Delta Airlines credit cards. So how do you decide? It's a question of loyalty versus flexibility. If you always stay with a specific hotel group, like Marriott, Hilton, or Hyatt, then that hotel credit card may be a good choice. If you're loyal to a specific airline, like if you live in a city that has a specific hub, like a Delta hub or United hub, then it might make sense for you to check out co-branded airline cards, because then you'll get perks that are specific to your most convenient or favorite airline.
We do have 2 flights coming up on Carousel 3.
Free checked bags, access to the United Club or Delta Sky Club. If you're not loyal to an airline or a hotel, a general travel credit card with a flexible rewards currency would probably be the best for you. Rewards for general travel credit cards are flexible, meaning you can kind of play the field. You can redeem your points and miles directly through the card issuer travel portal, or you can transfer them to one of many different airline and hotel loyalty programs. For example, like if you transfer your points to United, you now have United miles instead of Chase points, and you can only use them on United. Some general travel rewards cards give you access to high-end lounges, or possibly a TSA pre-check or a global entry application credit. If you're going to be traveling internationally, it makes sense to have a travel credit card that doesn't charge foreign transaction fees. These are normally a 3% charge that's tacked on to any purchase you make with a credit card when you're traveling abroad. So that can add up quickly, but if your credit card doesn't charge these fees, then you don't have to worry about it. Instead, that could just be rewards that you're earning that you can put towards your next trip. I make sure to pay off my monthly balance. Otherwise, the cost of carrying debt is more than the annual fee. Scan the QR code for more information about travel credit cards.
"18 is widely considered to be the age to open your first credit card. According to Experian, this allows you to have as much time as possible to establish a solid credit history. So if you're 18 or the parent of an 18-year-old, what do you need to know? Our very own Kendall Little has the 3 things beginners need to know about credit cards before applying. Kendall, good to see you. So first, you say, find out the type of card that you qualify for. For beginners, what options do they have?
Yeah, so if you're a beginner and you don't have any credit history, you're probably not going to qualify for those great travel or rewards credit cards like Ben was talking about before. Instead, you should apply for cards that you have a good chance of actually getting. This is because too many new card applications within a short period of time can actually have a temporary negative effect on your credit score. So, for example, student credit cards can be great if you're still in school. They often come with cashback rewards on everyday expenses like groceries and gas that you can use as a student. Secured credit cards are another good option, but you should be prepared to pay an upfront security deposit when you open one of these cards. And then if you're a parent and you have great credit, you might want to consider making your child an authorized user on your card account, and that can really help jumpstart building credit for them.
So what should someone have in front of them when they go to apply? What information, what data?
So applying for a new card is actually a relatively easy process. When you go to fill out your card application, you're going to need some personal information like your full name, your social security number, your address, and then you also want details like your income and your employment status. After you submit that application, some issuers actually will let you know instantly whether you're approved and may even give you access to your digital card so you can start using it, while others might make you wait a little bit longer or wait for that card to come in the mail.
So what should they know about building credit before they get started?
So for the first thing, building credit takes time. Like the saying goes, it's a marathon, not a sprint. But a big part of your credit score is going to depend on paying your balances off on time each month. So payment history is the most influential factor in your credit score. So you want to make sure that you make at least your minimum payment on time when your statement is due. And then another important detail for building credit is going to be your credit utilization. So how much credit you're using compared to what you have available. And to most effectively build credit, you want to make sure that you're not spending too close to your credit limit and keeping your balances low, or ideally paid off in full each month.
Kendall, thanks so much for breaking this down for us. Appreciate it.
Thanks, Brad.
Once you get established with your first traditional credit card, you may feel ready to graduate to a travel card. So we got the expert on all things travel and the points that you get with it to give the breakdown for all of the beginners out there. Brian Kelly, founder of The Points Guy. Brian, good to see you. What are the key features that some should look for in their first travel credit card?
Well, you want flexibility. I highly recommend everyone have a transferable points credit card. So this is a credit card that allows you to earn points into their currency. So whether that's Chase Ultimate Rewards, Amex membership rewards. And then the beauty of these cards is you can transfer to a number of airline partners. You don't have to get in bed with just one airline or one hotel. These cards offer lots of flexibility. So the Chase Sapphire Preferred, I would say, is the top travel card for people who want to get into that. And lucky enough, right now it's a 100,000 point sign-up bonus, which is worth about $1,250. And it's only a $95 a year card. So do the math there. It's a no-brainer if you can get approved for it.
So that sounds like it's your favorite card and why it is, but give us the beginner's guide to earning points with cards like this or others.
Yeah, so you want to look at every dollar you spend and you want to be earning points and ideally more than one. So you want to get cards that not just have those strong sign-up bonuses, but have category bonuses where you spend the most money. One of my other favorite generalist travel cards is the Amex Gold card. That gives you 4 points per dollar on dining and groceries. And we all spend a lot in those categories. You know, if you pay rent, the Built card is an absolute no-brainer. No fee, no annual fee, and no fees to pay rent. So basically you want to look at where you spend the most money and then get the credit cards that are going to give you points where you spend the most.
So what are the best practices for keeping track of your travel cards and staying on top of your bills if you have more than one?
Yeah, so, got to make sure you auto pay. That's the number one factor of your credit score. You never want to miss a payment. And ideally, you never want to pay interest. These travel rewards cards can have up to 30% APR. So, the value of the points you earn are completely negated if you're carrying balances. So these are not the cards, if you do have balances, you want to get 0% APR. The value there of not paying interest will far outweigh points. So the points credit cards are really for people who can pay them off in full every month. So you're not paying any interest. And then you can use those valuable points for really rich travel redemptions.
And so when you are going to book travel, you've got your destinations all lined up, how do you decide which card to actually use and put to work?
It's a great question. So that, redeeming points is where it becomes a little bit challenging, but luckily there's a lot of new tools out there that will do the math for you. Because most credit cards, so say you have a Chase Sapphire card, Sapphire Preferred, you can redeem those points for 1.25 cents a piece. So 100,000 points, you can buy a $1,250 flight. However, those same 100,000 points, if you were to transfer them to, say, Air France, which is one of their transfer partners, that could get you a round-trip business class flight that is $5,000. So you can get a lot more value when you transfer sometimes, but there has to be availability. There are tools out there like point.me. It is a tool that'll search all of the available partners for the credit card programs that you have. And actually, if you have Amex points, like an Amex Gold or Platinum, point.me/Amex, you can use that tool for free anytime you want to use points. So it'll tell you if it's cheaper to transfer to partners or whether you should just book directly through the credit card travel portal.
Is there an airline that has the best travel credit card? We hear about all of them kind of layering up their own investments in the premium offerings as of right now. But for some of the users of their travel credit cards, where are they getting kind of the most bang for their buck?
Well, at the Points Guy, we value all the credit or airline and hotel currencies. I love Alaska Airlines. Their miles are part of One World. They have really low redemptions, low fees, good availability, a good award search. And then my second of the major three, American Airlines, I think has the best program. You can still book really valuable awards, 70,000 miles to fly their partner Qatar Airways to the Maldives in business class. That could easily be a $5,000 flight. So, those are the two programs of the U.S. airlines that I get the most excited about.
Brian, great to grab some time with you. Thanks so much for breaking this down.
Thanks for having me. Safe travels.
Let's do a final check of the markets as we're taking a look at the major averages here on the day. We are mixed right now, lower by about 0.4% for the Dow Jones Industrial Average. The S&P 500 flat just barely to the upside, we'll call it 0.1%. And the NASDAQ Composite, you're seeing that hold on to some gains right now. The tech-heavy average up 0.4%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close.